Most traders approach silver as if it were a cheaper entry point into the gold market, applying the exact same strategies to both assets. Historically, this makes sense. For thousands of years, silver has functioned as a monetary metal and a store of value, often moving in tandem with gold as a hedge against inflation. However, while institutional gold is largely hoarded in massive central bank vaults as a stable reserve, the silver market operates with a much higher degree of speculative intensity. Silver is what traders call a high beta asset. Because its market is significantly smaller than gold's, the same amount of buying or selling pressure triggers much faster price movements. This chart shows how that relationship looks in practice. While a 1.5% rally in gold is significant, silver's high beta nature can drive a 3% spike over the same period, reacting with nearly double the magnitude. If you use a stop loss designed for gold stability on an asset with this much velocity, a routine intraday swing will likely knock you out of the trade before the move even develops. Capturing silver's amplified returns requires looking past the cheap gold label and identifying the specific industrial and economic forces that generate its volatility. Silver possesses a split personality, with its price driven by two distinct and often competing economic forces. On one side, it remains a monetary metal. It reacts to shifts in the US dollar and real interest rates, becoming a primary target for investors when confidence in fiat currency drops. But unlike gold, over 50% of silver's annual demand comes from its use as an industrial commodity. This demand is anchored in green energy growth. Silver paste is a required component for conducting electricity out of photovoltaic cells in solar panels. It also plays a critical role in the automotive sector.
Every electrical connection in an EV, from battery management to interior electronics, relies on silver. This extends to the broader tech sector, where silver is essential for 5G network infrastructure and the high-performance circuit boards found in modern smartphones. When these industrial requirements collide with safe haven investment demand, the pressure hits a market cap that is only a fraction of gold's total size. The resulting price action isn't random. It's the result of these two global engines operating within a highly liquid but physically constrained market. To navigate this environment, institutional analysts look at the relationship between the two metals, specifically the gold-to-silver ratio. This ratio tracks exactly how many ounces of silver are required to purchase a single ounce of gold, providing a clear view of relative value. A falling ratio means silver outperforms gold. Breaking below key support signals silver's demand is outpacing gold's safe haven status. This relative strength is a tactical signal. If you're bullish on precious metals, XAGUSD is positioned to deliver a more significant move than XAUUSD. By following the ratio chart, you can identify the specific windows where silver's higher beta offers a mathematical advantage. Executing these trades requires a shift in risk management. Silver's impulsive nature means that tight, fixed-pip stop losses will often fail. Technical setups should focus on continuation patterns like flags or pennants, confirmed by moving average crossovers and RSI levels to identify true momentum. To survive the wider price swings, you have to use a volatility-based tool like the average true range, or ATR. Setting your stop at an ATR multiple creates a buffer against normal market noise, keeping the trade structure intact. Because a wider stop increases risk per unit, reduce your lot size accordingly. This ensures your total account risk remains a constant 1%. You can test these volatility-based position sizing techniques and use advanced ratio charts with an FXNX demo account. Integrating intermarket signals with structured risk management allows you to capture silver's higher velocity while protecting your capital from its inherent volatility.